Hi, I'm Wes Burke, the CEO of Central Coast Lending. I've got a fresh mortgage market update for loan officers, locked and loaded. Let's jump in.
Good morning. Here's the tape for Monday, June 8th. If you only watch three things this week, watch oil inflation and the 10-year. Friday's jobs report reminded the bond market that the economy still has some heat. Payrolls came in at 172,000, unemployment held at 4.3%, and average hourly earnings were up 3.4% year over year. Bonds sold off immediately. This morning, the 10 years around 4.54%, agency MBS are roughly unchanged to slightly weaker versus Friday. And Mortgage News Daily had UMBS 5.0 at 97.70 and UMBS 5.5 right around par. That's not a liquidation tape, but it is a defensive tape. And yes, the Iran conflict is still the mortgage market story. Chrisman and Mortgage News Daily are both framing it through oil and inflation, not just geopolitics. Reuters had Brent at $94.19 and WTI at $91.33 late Monday morning in London after an overnight spike of more than 5%. When oil jumps, inflation expectations rise, and when inflation expectations rise, bonds demand a higher yield. Mortgage rates are feeling it, but spreads are cushioning some of the blow. Freddie Mac's weekly 30-year average is 6.48%. MBA's contract rate is 6.57%. Mortgage News Daily's daily index closed Friday at 6.66%. Using the daily mortgage rate versus the 10-year, the mortgage treasury spread is still about 212 basis points versus a historical norm closer to 170 to 180. Housing Wire's point is the important one. Better spreads are a big reason rates are not above 7% right now. Now, the next big lever is inflation. April CPI came in at 3.8% year over year, and April PCE also ran 3.8%, with core PCE at 3.3%. CPI for May hits Wednesday morning, then PPI Thursday. Chrisman's Monday setup says the market is braced for roughly 4.2% headline CPI and about 2.9% core. If that inflation data comes in hot, lenders will defend rate sheets quickly. If it comes in softer, there is room for mortgage pricing to recover faster than a lot of clients think because spreads still have some cushion. So what does that mean for loan officers? First, do not float blind into CPI and PPI on short fuse deals. If a purchase is closing inside 15 to 21 days, be disciplined. Second, lean into purchase, not a fantasy refi wave. Purchase demand is better than the headlines suggest. Pending home sales rose 3.2% year over year in April. Purchase apps are still 7% above last year even after the latest weekly pullback, and median down payments fell to $23,400, down 19% year over year. Buyers are getting more negotiating room even with rates elevated. Third, make that your script. This is a market for seller credits, builder incentives, temporary buydowns, FHA, VA, and first-time buyer conversations, not waiting for perfect rates. Government-backed programs are helping broaden the buyer pool, and that gives you a very real education angle with agents and borrowers. And fourth, call every stalled pre-approval from the last 60 to 120 days. Tell them rates are volatile, inventory and negotiation leverage are better, and you're helping clients structure payments creatively. Bottom line, the market starts the week defensive, but not broken. Oil and CPI are in control. If they behave, we can stabilize. If they don't, expect worse pricing. Stay close to your locks, stay close to your realtors, and stay on offense with purchase business.
That's the update for today. I hope you get value out of these. Central Coast Lending is a relatively small correspondent lender. We offer control through in-house underwriting, an incredible tech stack, great support, competitive pricing, competitive commissions. If you think this might be a fit for you, I'd love to hear from you. My contact information is on the screen. See you next time.